History is repeating itself with bonds, my friends. This is no, not doing that. No, sir. No growling. How dare there be another dog in the neighborhood who barks? Anyway, so check this out. I'm going to go to Schwab and look at bonds. All right, so I just typed in 20-year Treasury bonds. So we got a U.S. Treasury. It matures November 15th, 2042. So basically 20 years from now, roughly. The coupon is 2 3/4, 2.75. All right, so for every $100,000 you put in, you get $2,750 a year. All right, that's if you bought it at issuance. Now, the price right now is $84. That means you're paying a 16% discount, right? Which means the yield is 3.867. This guy. Now these are pretty steep discount bonds, man. If we go to price, does it let us do it? But no, I guess we can't. But here's a discount. Here's a premium bond, 102. All right, that matures again in 20 years or so. But here the coupon's 4%, which is higher than what coupons are today. All right, so if you went out in the market and buy a brand spanking new 20-year Treasury bond, it would not be 4%. It'd be about 3.85 or something like that. But look at that, steep discount. But notice the yields are all roughly the same, 3.8. So we got a deep discount bond, a premium bond. They're all about the same yields. Isn't that interesting? So here's a tip. That's inflation protected. But anyway, so 84, 86. Let me pause real quick. Here's a Treasury bond that was issued in November 2022 with a 4% coupon. And they're saying the evaluated price is 106. So you would buy this bond, essentially you'd buy it for a premium because the yields have gone down. The interest rates have gone down and the yields have gone down. I mean, so you got right here, you say, I'm going to go out in the market today and I'm going to buy a bond that was issued at $100. That was a par value. I'll buy for 106 today because the yields have dropped. And that's on a 30-year Treasury. Actually, let's take a look at what the 30-year Treasuries are doing right now. And there's method in my madness here, my friends, so stay tuned. All right, so hang in there. So we got a 30-year Treasury, 3.66. Yeah, so there you go. So anyway, so let's keep going now. All right, so that I hope that makes sense. So right now, because a 30-year Treasury is 3.66, a 30-year Treasury that's just issued back in November is yielding 4%. Of that 4% coupon, you got to pay a premium for that, and you're going to pay a 6% premium. All right. You're going to pay 106 because you'll equal the current yield. All right, let's keep going. All right, so here I don't want tips. Hold on a second. So here I did 5-year bonds, all right, that have a coupon of coupon of 0.75 that's going to mature in 2028. All right, the price is well below par, even though it's only a 0.75%. Look at that. So let's take a look here. Look at that evaluated price, 86. That's nuts, man. Nuts. Well, and the reason for that because you're only getting 75 basis points, which makes sense. I was just as amazing how different these bonds have changed just over the last freaking year. Basis nuts. All right, so anyway, so I want to go down. So that's a deep discount. Look at that, deep discounts across the board. 2.75 matures in 2028. I mean, these are all trading below par, significantly below par in some regards. 89, there's 110 because the yield there is 3.358. That's another. I don't see. I'm not interested in tips. But anyway, so here significantly below. I mean, look at that across the board, below par. 86, 86. So just remember what that means is all these bonds are going to mature at 100. All right, so I want to show you something here. We're going to go to 1919. And this is from, I'm not sure what newspaper, New York Times or something. All right, so 1919, you got a Liberty bond matured. I actually want to look at this. 1938 Liberty bond. That means it matured in 20 years, from 1919 to 1938. Had a coupon of 4 1/4. All right, had a coupon of 4 1/4. The yield was 4.7. What we have here is we have a bond has a coupon of 4.25 and a yield of 4.7. So how do we figure out the price of this bond? Hey, look, I got my napkin. I need to eat it. Yay. All right, so what we do to figure out the price, we know this is trading at a discount, all right, but we're going to show you how. So we go current yield equals, I always got to remember how I do this thing is coupon over price. All right, so current yield equals coupon over price. So that means if you, for instance, if you don't know your current yield and you have a coupon of 4 and a price of 100 and you don't know what your current yield is, you just simply take 100 divided by 4, or I should say you take 4 divided by 100, and that gives us a 4% current yield. All right, so the current yield equals 4%. All right, so that's what I always do, because I always forget this, the number, how you do this. So current yield equals coupon over price. Current yield equals coupon over price. So here we had a current yield, I think it was a 4.7, something like that, equals coupon over price. So 4.7 is the current yield. The coupon was 4.25. We got to solve for X. And this back in 1919. And what we do to solve for X is we go X equals, what do we do here? 4.225 over 4.77. That's what it was. So X, because that's just basic, I don't know, is that algebra? I don't know, math. Arithmetic. X equals 4.25 over 4.77. 4.25 divided by 4.77 equals 89. So that bond right there is trading about $89 when the par value is at 100. Now I'm going to show you why this is a big deal. All right, so always remember, if the yield is above the coupon, it's trading at a discount. Just keep that in mind. If the yield is below the coupon, it's trading at a premium. So in this case, we got I don't want to say significant discount, but we got 11% discount. You're getting a 4.25 bond. You're getting $4,025, $250 every $100,000 you invest in every year. Now it's not compounding. You just get the interest. All right, but this doesn't mature until 1938. All right, so let's go back a little bit. Hold on a second. You were getting 4.25. Now in 1929, 10 years later, we have an average of 40 bonds that are trading at 87 bucks. 87 bucks in 1929 June. So the average of bonds is 13% discount. Isn't that interesting? Huh. 1929. Bonds are trading at a steep discount. Bond issues less in age of stocks, June 16th, 1929. A radical change in the method of financing the needs of the great industrial and railroad corporations of the nation has been going on for the last 2 years. So gradually that its existence has but recently impressed itself upon the street and the banking fraternity. Reference is made to the practical elimination from the commercial paper market of our largest corporations, the lessening number of commercial paper brokers visiting bank after bank presenting a list of paper they have for sale, usually by the very best grade of credit security, always considered next to governments and collateral. Big corporations have found that the market will take practically all the common stock they are required to issue to finance their immediate needs. Aided by their accumulation of surplus from the important growth in business that has developed in recent years. You hear that? Corporations can issue stock to finance their debts. Bond issues like commercial paper mature and at a different rate of interest. They are also evidence of corporate debt. Therefore, there is a disposition to substitute common shares for bonds. Few bond issues coming out. Enlargement of stock market operations, a demand from the general public on a gigantic scale for stocks for more than 2 years, was the chief factor in bringing about the changing condition in the paper situation. Interesting. Now we fast forward 6 months. Brisk accumulation of United States government securities debt at advancing levels featured today's transactions in the bond market. Liberty 4.25 and Treasury 4.25 advancing to fresh peaks for the year. Interesting. Bond market roundup in 1929. The one self-evident fact in the history of investment markets in 1929 is that the general public almost completely divorced itself from bonds during 11 months of the year and took a cautious but inquiring interest in them in the month of December. Isn't that interesting? The evidence, let me see real quick. Graph of bond prices from January to October shows a fairly steady decline, which covered an average between 6.5 and 7 points for domestic issuers. It was a continuation of the trend of the second half in 1928. Within this period, the composite bond list touched a level lower than it had been since the start of 1925. But early in October, the market began to exhibit strength and reflect some transfer of funds from the stock market and also purchases by institutions whose portfolio of corporations' mortgages have been allowed to run down while it's expanding in the direction of real estate mortgages. Within a 3 weeks rally of several points occurred, it began to look as though bonds had been a definite revival. Then came the 1st of October, breaks in stocks. This immediately changed the entire aspect of the investment market. All right, so anyway, the point being is, there was from basically 1928 until the end of 1929, there was a bond market depression. Why would that be? Here's April 30th, 1930. All right, we got Dr. Haney at NYU, a retail school at New York University, forecast better times soon. I don't know who Dr. Haney is. I'm not bashing the guy, but a general recovery of businesses made by next October was a forecast made last night by Dr. Haney, who is the director of the Bureau of Business Research at NYU. About 300, listen to Dr. Haney said that business forecasting has gradually become a science. He gave as the basis for his prediction the analytical summary of favorable and unfavorable factors in a situation, accurate measurements of demand and supply, the business cycle theory, and special barometers. The bottom of the business recession has almost been reached, he said, and the most convincing signs of the coming of a sustained recovery are likely to be the stabilization of commodity prices and a downturn trend in unemployment. All right, so we know that was silly. Again, can we bash this guy? Sure, but this is what happens when you put your faith in science, dude. It's science. It's not science. It's all speculation. Even physics, speculation. Stop it. Stop it. The science says. All right, so the point, what does this mean? So if you could have locked in 4.77 in 1919, you missed out on the 20s, I grant you. But you also missed out on the Great Depression. All right, so the stock market did nothing from basically 1929 to like 1954 or something like that. Nothing. Even dividends reinvested, you basically got nothing. All right, now if you had bonds, you didn't make crack, you didn't make a freaking killing, but you didn't get killed either. That's just a fact, Jack. Kind of reminds you a little bit today, doesn't it? Yeah, it certainly does. It certainly does, man. We're looking at, in my opinion, sustained low-level growth. And what that means is the bonds that you can lock in at a high rate is 4 or 5%. I just think if you had a 4.77 government-issued bond in the Great Depression, dude, you were king of the hill, man. You were king of the hill. Are we going through the same thing again? I don't know. But inflation's going to eat us alive. Yeah, that's what we were hearing back then, too, and that's part of my book. The threat of inflation has been persistent forever. Doesn't mean it's not there. It just means you got to measure it correctly for yourself. All right. Love your thoughts. Don't forget to subscribe to Doobie Dukes down below, my email list. And then the Locals channel will be going live tomorrow at 4 p.m. on Locals. All right. We'll see you.